So let's review chapters 1 through 3 in accounting. So the way that we're going to do this today is work through one entire problem from journalizing transactions, posting those transactions into T accounts. We're going to prepare trial balance. We're going to journalize and post some adjustments, prepare an adjusted trial balance, and then prepare our financial statements. So here's the problem that we're going to work through. I would recommend, if you're watching this video back, to take a screenshot of this or take a picture on your phone. That way you can have it there with you as we go through this problem. So Artichokes LLC began operations on July 1st. Then we have a list of transactions. So we can go through and we can journalize each one of these transactions. So the first transaction that we're going to journalize here is Artie invests $30,000 in the business Artichokes LLC. So the owner is putting money into the business. So the business is getting cash. So we need to show that the business's cash is increasing. And the way that we increase cash, since it's an asset, is we debit that account. Now, the other half of this is that Artie is becoming an owner of this business. So we need to credit owner's capital for this $30,000 amount. So that's our journal entry for the first transaction. Now we have another transaction here on July 1st. We signed an office space rental agreement paying $6,000 for 6 months of office space. So since we are paying in advance for multiple months of rent, we call that prepaid rent. Prepaid rent, just like cash was, is an asset. And so we are increasing the amount of prepaid rent that we have by $6,000. Now, how did we pay for this prepaid rent? Well, whenever we see the word that we paid right then and there, we know that we used cash. So we credit cash for this $6,000 because we need our debits and credits to equal. And we credit cash to make that account decrease. So our prepaid rent's going up, our cash is going down. Now, July 3rd, we purchased $15,000 of equipment, paying $5,000 in cash, and the remainder is on account. So this one's a little bit more complex than the first two. We're going to need to use 3 different accounts here. Whenever we use 3 or more accounts in a single entry, we call that a compound entry. So, the first piece, we purchased $15,000 of equipment. So, the company needs to show that they got equipment. Equipment's an asset, and so we need to increase that account with a debit. So we debit equipment for $15,000. Now, how did we pay for this equipment? Well, some of it was a down payment with cash. So we show that our cash went down by $5,000 by crediting cash for that amount. And then the remainder is on account. What that means is that we are going to pay the remainder later. And whenever we are going to pay something later, we are thinking of a payable account. Here we'll be using accounts payable. So we credit accounts payable for the remainder. So if we need to make our debits and credits equal here, we initially had just this $15,000 on the debit side and $5,000 on the credit side. So that's why we needed this additional $10,000 over on the credit side. Now July 6th, we buy $500 of supplies on account. So we're purchasing supplies. We're purchasing paper, pencils, think of it as office supplies. So our supplies account has to increase. So we debit that supplies account by 500. And how did we pay for these supplies? Well, it tells us that we bought them on account. And whenever we see on account, we can be thinking accounts payable. So we credit accounts payable for 500. Now July 10th, we received a $10,000 payment from a customer for future services. So someone paid us here on the 10th, but we aren't going to do the work for them for another week or two, let's say. So we're getting money, right? Artichokes LLC, we are getting $10,000. So we need to show that our cash is going up by $10,000. And so we debit our cash for $10,000. Now, why did these people give us $10,000? Well, it's from a customer for future services. And so whenever we receive payment for future services, we will call that unearned service revenue. So unearned revenues are liabilities because we are liable for this future service. So unearned service revenue is increasing here with this credit of 10,000. So now on July 12th, it says Artie withdraws $1,000 cash for personal use. So Artie, the owner of the company, is taking money out for personal reasons. We call that owner's drawings. So whenever an owner takes money out for themselves, it's owner's drawings. And drawings go up with debits, so that account is increasing. Now, what is Artie taking out of the business? Cash. So the business now has less cash, so we need to credit our cash for that 1,000 as well. Here on July 14th, it says perform services worth $3,000 and bill the customer for the amount. So we are performing these services and we aren't getting paid right now. We're billing our customer. So whenever we see that we are billing our customer and they owe us money, we're going to get paid later, we can debit accounts receivable. Accounts receivable is for when people owe us money. And so accounts receivable is an asset. And so with this debit, our accounts receivable is increasing by 3,000. Now, why did we bill our customers? Why do they owe us this money? Because we performed services. We did work for them. So we credit our service revenue, because revenues go up with credits. So we credit that account for that 3,000. Now on July 18th, we paid employees a total of $2,000. So we have these employees and we have to pay them now. And whenever we pay our employees, we can call that a salaries expense. So that expense account is increasing with this debit. Now, how did we pay our employees? We used cash. So our cash is credited, our cash is decreasing by 2,000. Now on July 21st, we received payment in full from a customer billed on July 14th. So if we take a look back on July 14th, we billed our customer $3,000. Here on the 21st, they're going to pay us. So How do we journalize this one? Well, we are receiving payment. So we're getting cash. So our cash has to go up. And we get that 3,000 from our journal entry back on the 14th, because it tells us that they paid us in full. So our cash is going up 3,000. And we also have to show that our accounts receivable is decreasing by 3,000. We do this because our customer no longer owes us this money. Our customer paid us back, and so we have to show on our books that our accounts receivable is going down. So 2 more entries here. On July 28th, we paid creditors $2,000 for amount owed. A creditor is just someone that you owe money to. Right? So we owed $2,000, or paying people back $2,000 of the amount that we owed. And so we need to show that what we owe is decreasing. So whenever we owe money, that's accounts payable. So we need to decrease our accounts payable here by debiting that account. And we're paying our creditors. So we need to show that our cash is also decreasing by 2,000. So now July 30th, it says performed services for a customer. We earned $12,000 in revenues, received $8,000 in cash, and the remainder is on account. So this is pretty similar to what we did up on July 14th, but there's an extra piece to it. So we performed services for a customer. Well, back on the 14th, when we performed services, we knew that service revenue had to be included. So we will be including service revenue here. But it tells us that we received $8,000 in cash and the remainder is on account. So the remainder on account means that we're billing our customer for that piece that's left over that they haven't paid us for yet. So we can break this down into the 3 accounts that are affected. We are receiving $8,000 in cash. So we need to show that our cash is increasing by $8,000. The remainder on account means that we billed our customers. So they owed us $4,000 for this work. And so we increase our accounts receivable by $4,000. And service revenue, we credit service revenue for the total amount of work that we did. Not just what we got paid for, but the total amount of work that we performed. So those are all of our journal entries for those transactions. Now, if you were told to prepare a trial balance, you would first need to be able to figure out all of the account balances. So the way that we're going to do that is with a T account. So if we go through entry by entry and see which entries affected cash and how was cash affected, we can then find our balance for our cash account. So our very first entry, we debited cash 30,000. So we put the debits over on the left side of this T account. Also on July 1st, we credited cash of 6,000. So credits go over on the right side of this T account. On July 3rd, we credited cash of 5,000. On July 10th, we debited cash of 10,000. On July 12th, we credited cash $1,000. On July 18th, we credited cash of $2,000. July 21st, we debited cash of $3,000. On the 28th, we credited cash of $2,000. And then on the 30th, we debited cash of $8,000. So we have all of the transactions that affected cash in our T account. Now we can find the balance. So cash is an asset. Assets go up with debits and down with credits. So we can add up our 4 debits and then subtract our 5 credits. And if you do that, you will end up with a debit balance of $35,000. Because there's more over on the debit side. So, you can use T accounts to find the balance in all of the remaining accounts. So if you're watching this video back, you can pause right now and make T accounts for each of these accounts on your screen, and then you can go through all of the journal entries and post to your T accounts to find the balances. If we go through the answers for all of these, your accounts receivable should have $4,000, supplies $500, prepaid rent $6,000, equipment $15,000, accounts payable $8,500, unearned service revenue of $10,000, owner's capital is $30,000, owner's drawings is $1,000, service revenue is $15,000, and salaries expense is $2,000. So now that we have all of the balances for our accounts, now we can move on, and now we can prepare a trial balance. So you'll notice up at the top of the screen, we have the company name, Artichokes LLC. We have what we are preparing, a trial balance, and we have the date, because we are doing this at the end of July. So when you're making a trial balance, there's a certain order that your accounts need to go in. So we list them out in the same order that your expanded accounting equation is in. So assets, liabilities, owner's capital, owner's drawings, revenues, and then expenses. With assets, there's a certain order that the assets need to go in as well. That order is called the order of liquidity, which means how quickly can we turn this asset into cash, or how quickly are we going to use it up. So the most liquid asset every single time will be cash. So we always list cash first on a trial balance. Now, cash had a balance of $35,000. It's an asset, so the balance goes under the debit column here on the trial balance. After cash, accounts receivable. So accounts receivable is another asset, so its balance of $4,000 is in the debit column. After accounts receivable will be supplies. It's another asset, so its balance is a debit. Prepaid rent has a balance of $6,000, and that's another asset, so we put that in the debit column. And then equipment has a debit balance of $15,000. So those are all of our assets. After our assets, then we can start listing out our liabilities. So our liabilities will have credit balances because liabilities go up with a credit. So accounts payable has a credit balance of $8,500 and unearned service revenue has a balance of $10,000. So those are our only two liabilities. After your liabilities are your owner's equity accounts, right? Your capital, drawings, revenues, and expenses. So we list out owner's capital. Owner's capital, just like liabilities, goes up with a credit. So our capital balance goes over on the credit side. After capital comes owner's drawings. Drawings go up with a debit. So its $1,000 balance is in the debit column. After drawings, we list out our revenues. We only had one revenue account here. So our loan revenue, service revenue, has a balance of $15,000 over in the credit column. And after revenues, we list out our expenses. We also only had one expense, and so we list out our one expense, salaries expense, with a $2,000 debit balance. So there's one more pretty important step here for a trial balance. After you've listed out all of your accounts and all of their balances as either a debit or a credit, you then need to total up your two columns. Because what we want to make sure of here is that our debits equal our credits. So if you add up your debit column, it'll equal $63,500, and if you add up your credit column, it'll equal $63,500. If they do not equal, that means that you've done something wrong earlier on. So that's a check for yourself as you're going through this process. So after preparing a trial balance, we can then journalize our adjusting entries. So we have 5 different adjusting entries that we'll have to make here. So once again, if you're watching this back, I recommend taking a picture or a screenshot of the screen right now so you can have that information with you as we are going through the adjusting entries. There's a few different rules that we will use while making adjusting entries. These entries are going to need to have a debit to an expense or a credit to a revenue. The other account in every single adjusting entry will be a balance sheet account. So those are your assets, your liabilities. And then the third rule is that we cannot use cash. Cash will never be used while preparing adjusting entries. So let's go through and make this first adjusting entry here at the end of the month. The piece of information that we were given was that $150 of supplies were used in July. Well, we had 500. We used up 150 here. So we need to show that our supplies were decreasing by that 150. And to decrease your supplies, since supplies is an asset account, we would have to credit our supplies. So we will be crediting our supplies in this entry, which leaves the debit spot open. And one of our rules earlier on was that if we needed to debit an account, it had to be an expense. So we will debit supplies expense of 150, and we will credit our supplies of 150. Now, for the second one, employees are owed $1,800 and will be paid on August 2nd. So it's not payday yet, but we still need to count the expense in the month that it happened. So we need to count our salaries expense in this month. So we will debit our salaries expense for $1,800, and we aren't paying them right now, right? So we definitely don't want to use cash. We're saying that we're going to pay them later. Now, in the previous journal entries, when we owed money to a creditor, we just called that accounts payable. Here we have a more specific account for salaries, which we call salaries payable. So we will credit our salaries payable of $1,800. Now our third one here says the equipment has depreciated $125 this month. So our equipment is losing value, right? So equipment, you could think of that as a delivery truck. So once you start using your delivery truck, or really once your delivery truck starts getting older and older, its value goes down. It's depreciating. So what we do here to journalize this is we debit depreciation expense for this $125, and we're going to credit this new account that showed up in chapter 3 called accumulated depreciation equipment. So accumulated depreciation is a contra asset account, meaning it goes against one of your assets on the balance sheet. So it is increasing with this credit since it acts as the opposite of an asset. So now the fourth one, $8,000 of the unearned revenue remains unearned. Well, we had $10,000 of unearned revenue initially. So if 8,000 of it remains unearned, that means that we've earned 2,000. We've earned the difference. So we need to decrease the amount that we have in our unearned service revenue. And since that's a liability, to decrease it, we will debit our unearned service revenue of 2,000. So we think back to the initial rule that I talked about. We would either debit an expense or credit a revenue. Well, we know that we're not debiting an expense here. So that means that we must credit a revenue account. And which revenue account should we credit? Service revenue. Because we've now earned some service revenue. So we need to increase our revenue account. Now our fifth and final adjusting entry, 1 month of the 6-month rental agreement has expired. So way back on July 1st, we signed a rental agreement for office space, and we paid $6,000 for 6 months. Well, we've used up July, right? We've been in that office space for a month, so we now have 1 less month in this agreement. So we need to show that our prepaid rent will be decreasing. Prepaid rent is an asset. So to decrease an asset, we'd be crediting our prepaid rent. But first we need to figure out what our debit would be. Well, if we're crediting an asset, that means that based off of the rules that we have, our debit must be an expense. So since we're dealing with rent, we will debit rent expense of $1,000. And prepaid rent, we credit for $1,000. So we got that $1,000 by looking back at our initial transaction on July 1st. we paid $6,000 for 6 months. So 6,000 divided by 6 gets you a monthly amount of 1,000. Now, one last thing before we move on to an adjusted trial balance. Take note of the account titles in these adjusting entries. We have supplies expense, supplies. Salaries expense, salaries payable. Rent expense, prepaid rent. You notice a lot of similar words in these adjusting entries. That's going to be the case 95% of the time. So if you know that it needs to be an expense, just rack your brain for an expense that has a similar word to what account you are crediting. So now we can move along and make an adjusted trial balance. So we'd want to post those adjustments as well, these adjustments that we made in our adjusting entries, to find the new adjusted balances of these accounts, right? Because a few of our accounts here are going to have different balances than they did initially on the first trial balance that we made. So you can post these as well to those T accounts that you've made and recalculate the balances for all of these accounts. Now, an adjusted trial balance. The thing that changes is just the balances are after the adjustments. We still want to list them out in the same kind of order. Assets, liabilities, capital, drawings, revenues, expenses. Our assets are still in order of liquidity. Our asset balances will be debits. Our liability balances will be credits. Those pieces do not change. We'll have a few new accounts in here that we saw pop up in our adjusting entries that we didn't initially have, and accounts will have new balances. Those are the changes. So we want to list our assets first, and our assets have to be in order of liquidity. So the most liquid asset all the time is cash. We didn't touch cash in the adjusting entries, so its balance remained the same. After cash is accounts receivable. Once again, accounts receivable was not affected in our adjusting entries, so it still has a $4,000 debit balance. After accounts receivable comes supplies. Now, supplies was initially $500, but we used up $150 worth, so now there's only $350 left in supplies. After supplies comes prepaid rent. Prepaid rent was initially $6,000, but we used up a month of our prepaid rental agreement, so that went down to $5,000. After prepaid rent comes equipment. Equipment was not affected, right? Equipment ended up depreciating, but we did not affect the equipment account itself. That account was only affected whenever we buy or sell equipment. So equipment still at $15,000, but right underneath equipment, we put the contra asset. We put our accumulated depreciation on this equipment, and it has a credit balance of $125. So after our accumulated depreciation, we can start listing out our liabilities. So accounts payable wasn't affected, so it still has a credit balance of $8,500. After accounts payable is unearned service revenue. So if you remember, unearned service revenue was affected in our fourth adjusting entry. Right? We decreased it by $2,000. So now it only has $8,000 left in that account. After unearned service revenue, we had another liability show up in our adjusting entries. We saw salaries payable. So we credit salaries payable for $1,800. After salaries payable, we can start listing out our equity accounts. So we start that with capital. Owner's capital was only affected by that very first entry that we did on July 1st. It hasn't been affected since. So it still has a credit balance of $30,000. After the capital is the drawings. The drawings still have a debit balance of $1,000. After our drawings are our revenue accounts. Now, revenue initially was $15,000, but we saw in our adjusting entries it increased by $2,000. So we increase it up to $17,000 now, and it's still over on the credit side. That's our only revenue account. So then we start listing out our expenses. So salaries expense initially was $2,000, but then we had another $1,800 worth of salaries. So that increased its balance up to $3,800. Then we list out our rent expense. I'm sorry, that should just be $1,000. After our rent expense is supplies. So our supplies expense of $150. Then our depreciation expense of $125. And that's all of our expenses. So the last step that we did with our initial trial balance was adding up the debit column and adding up the credit column, where you want to do the same thing here. So when you add up the debit column, you should get $65,425. When you add up the credit column, you should get $65,425. Again, that's not a coincidence. Our debits must equal our credits. So, after we have an adjusted trial balance, we can then use that to start preparing our financial statements. Right? So we have these 4 financial statements that we need to know about. We know the income statement, owner's equity statement, the balance sheet, and then the statement of cash flows. So you don't need to know how to prepare a statement of cash flows quite yet. But those first 3, an income statement, owner's equity statement, and a balance sheet, you need to know how to prepare every single one of those statements. So there's a certain order that they go in. The first that you make is the income statement. So the income statement has revenues and expenses. So you'll notice up at the very top, we have our company name, we have which statement we are preparing, and then we have for the month ended July 31, 2020. So an income statement is for a period of time. And since we are just dealing with 1 month in this problem, our income statement will be just for the month of July. So our revenues. We only had one revenue, right? We only had service revenue. So we can write out service revenue and put its balance all the way on the far right. If we had multiple revenues, we would have to put that $17,000 closer to the middle of our income statement. And then the total revenues, once we add up all of our revenues, that would go over on the far right. We'll see an example of that down here with our expenses. Because with our expenses, we had multiple expenses here. And we want to list these out in order of greatest to least. So we had salaries expense of $3,800, rent expense of $1,000, supplies expense of $150, and depreciation expense of $125. So you'll notice how those numbers are more so in the middle than over on the far right, because the far right side, we just want to keep that for total revenues, total expenses, and then our eventual net income here on the income statement. So when we have all of these revenues, or all of these expenses in this case, we want to add them up. So if we add up our 4 different expenses, we'll end up with total expenses of $5,075. So now we have our total revenues of $17,000, our total expenses of $5,075, and we can take our revenues minus our expenses to get our net income of $11,925. So the reason that we prepared an income statement first was because we need this net income amount over on our owner's equity statement. So the owner's equity statement gets prepared next. You'll notice that that's also for the month ended July 31, 2020. On an owner's equity statement, the first line will be your beginning owner's capital. Now, our owner's capital here on July 1st, it's 0. It's 0 because the business started on July 1st. So going into July, there was nothing in owner's capital. Later on July 1st, there was that investment. But when we woke up that morning on July 1st, that investment had not been made. And so a new company's beginning owner's capital will always be 0. Now, after we list out the beginning capital, we list out the pieces that are added to the capital amount. Stuff like that $30,000 investment, right? So this is where that investment comes into play. Another piece that is added is your net income. So we needed to know our net income to prepare this owner's equity statement. So we add up those two amounts and we get $41,925. We then add that $41,000 to our beginning owner's capital. In this case, it's 0, so we just write out $41,000 again. But know that what you're doing in that step is adding those numbers together. 0 plus $41,925 gets you $41,925. Now, what gets subtracted on an owner's equity statement? Your drawings. Another piece that could be subtracted would be your net loss if you had more expenses than you did revenues. But in this case, we had a net income, so the only piece that gets subtracted are those owner's drawings. So we subtract that $1,000 from our $41,925, and we end up with an owner's capital on July 31st of $40,925. Now, we prepared an owner's equity statement second because we need that owner's capital number, that $40,000 number, to make a balance sheet. So now we can prepare a balance sheet. You'll notice a balance sheet does not say for the month ended July 31. It just has the date. A balance sheet is just a snapshot in time. So we only put the date that you are preparing this balance sheet. So a balance sheet is proving your accounting equation. So your accounting equation is assets equals liabilities plus owner's equity, right? So let's first list out all of our assets. Just like when we were making a trial balance, our assets have to be in that order of liquidity. So we have our cash of $35,000, accounts receivable of $4,000, supplies of $350, right? We want to make sure that we're getting these numbers from our adjusted trial balance. After our supplies comes our prepaid rent of $5,000. Now for equipment, you'll notice the number moved inside. So equipment of $15,000. The reason that it moved inside like that is because then we need to subtract our accumulated depreciation on this equipment, because it is lowering the equipment's book value. So we list out the equipment, then we write less accumulated depreciation equipment, and you'll see that the new book value, when you subtract 15,000 and 125, you get 14,875. So we can now add up those numbers on the far right to find that our total assets equals 59,225. So we'll come back to that number at the end. Again, our accounting equation, assets equals liabilities plus owner's equity. So we've already listed out our assets. So now we're going to list liabilities and owner's equity. The first piece we want to list are the liabilities that we have. We have 3 different liability accounts. We have accounts payable of $8,500, unearned service revenue of $8,000, and salaries payable of $1,800. Now we want to make sure that we show the total liabilities by adding up our 3 different liability accounts. After our liabilities, we want to start listing out owner's equity. Owner's equity is an umbrella, just like assets or liabilities. The account that we're going to be listing here is our owner's capital. So we have that owner's capital amount from our owner's equity statement that we prepared on the last slide. So that's why we needed to make the owner's equity statement before making this balance sheet. So now that we have our total liabilities and we have our owner's capital, we can add those 2 numbers together to find that our total liabilities and owner's equity is 59,225. So you'll notice that your total assets and your total liabilities and owner's equity are the same. Just like when we were talking about a trial balance, that is not a coincidence. Debits and credits always have to equal, and your assets always have to equal your total liabilities and owner's equity.